Welcome to Money Collate, your central hub for insightful financial information. Today, we're taking a deep dive into the world of mortgages. So, what exactly is a mortgage? Well, in the simplest terms, a mortgage is a loan. But it's not just any loan. It's a loan taken out to buy property or land. The key thing about a mortgage is that it's secured against the value of your home until it's paid off. This means you have to repay the loan plus interest over a set period of time. And if you don't keep up your repayments, the lender can take back the property. There are various types of mortgages available, and the one you choose can greatly affect your financial future. Understanding the type of mortgage you choose can make a significant difference in your financial journey. Let's dive into it. First up, we have fixed-rate mortgages. As the name suggests, these offer a fixed interest rate. Now, what does that really mean? Well, imagine you're at your favorite coffee shop. You always order the same coffee and it always costs the same amount. That's what a fixed-rate mortgage is like. The interest rate remains the same for the entire life of the loan, regardless of what happens in the broader economy. One of the biggest pros of a fixed-rate mortgage is the predictability. You know exactly how much your monthly payment will be and it won't change. This makes budgeting a breeze. You can plan for your future without having to worry about fluctuations in interest rates or changes in your monthly payment. However, as with anything in life, there are a few cons to consider too. The fixed interest rate might be higher than what you'd get with an adjustable rate mortgage. This is because lenders need to consider the risk of interest rates increasing in the future, so they tend to set the fixed rate a little higher to cushion themselves against that potential risk. Additionally, if interest rates drop significantly after you lock in your fixed rate, you might end up paying more interest than necessary. Of course, you could refinance to take advantage of lower rates, but that comes with its own costs and considerations. Now, who might find a fixed-rate mortgage appealing? Well, if you're someone who values stability and predictability, this could be a great choice. It's also ideal for those planning to stay in their homes for a long time. With a fixed-rate mortgage, you don't need to worry about possible rate hikes or how they might impact your monthly payments. In summary, a fixed-rate mortgage offers a steady, unchanging interest rate for the life of the loan, which leads to predictable monthly payments. While the interest rate might be a bit higher compared to adjustable-rate mortgages, the predictability and stability can provide peace of mind. So if stability and predictability are your top priorities, a fixed-rate mortgage might be a good fit. On the other side of the coin, we have adjustable-rate mortgages, also known as variable-rate mortgages. Diving right in, adjustable-rate mortgages, or ARMs, offer a different approach to home financing. Unlike fixed-rate mortgages with their predictable, unchanging interest rates, ARMs keep things a bit more exciting. The initial interest rates on these loans are typically lower than those of fixed-rate mortgages. Now, that might sound like a fantastic deal, and for some, it really is. You see, the adjustable-rate mortgage means that the interest rate can change over time. The rate is tied to a specific index, such as the US prime rate or the London Interbank Offered Rate. When these indices go up or down, so does the interest rate on your ARM. This could mean paying more or less interest over the life of your loan depending on market conditions. Now, let's talk about the upsides. The lower initial rate can make home ownership more affordable in the short term. This can be a great option for those who plan to sell their home or refinance their mortgage within a few years. In this case, you could potentially avoid higher interest rates altogether. But with the good comes the not so good. The downside of an adjustable rate mortgage is the uncertainty. If interest rates rise, your monthly payments could also increase, sometimes significantly. This could potentially strain your budget, especially if you're not prepared for the change. Furthermore, ARMs often come with complex terms and conditions. Understanding these can be a challenge, even for the financially savvy among us. So it's crucial to read and understand every detail of your contract before signing on the dotted line. To sum it up, adjustable-rate mortgages offer potential savings through lower initial interest rates. However, they also involve a degree of risk due to the potential for increasing rates. Thorough research, careful planning, and a clear understanding of your financial situation and goals are key when considering an ARM. An adjustable-rate mortgage can be a smart choice if you plan to sell or refinance your home before the rate changes. Now that we've covered the basics of fixed and adjustable-rate mortgages, how do they stack up against each other? Let's dive right in. Fixed-rate mortgages, as the name suggests, have a constant interest rate throughout the loan term. This means your monthly payments remain the same over the life of the loan, which can span 15, 20, or even 30 years. This predictability can be quite comforting, especially for budget-conscious homebuyers or those who plan to stay in their homes for a long time. On the other hand, adjustable-rate mortgages or ARMs have interest rates that change over time. They typically start with a lower rate than fixed mortgages, which can make your initial payments more affordable. However, these rates can increase or decrease in the future, which means your payments can also go up or down. This variability might be a bit nerve-wracking for some, but it can be a good fit for those who expect their income to grow in the future or plan to move before the rate adjusts. So, how do you decide which is right for you? Well, it depends on several factors. If you value stability and predictability, a fixed-rate mortgage might be the way to go. However, if you're comfortable with a bit of risk and want to take advantage of initially lower payments, an adjustable-rate mortgage could be a viable option. It's also crucial to consider your long-term plans. If you're planning to stay in your home for many years, the fixed-rate mortgage's predictability might be more appealing. But if you're likely to move in a few years, an ARM's initial lower rate could save you money. Lastly, consider the current interest rate environment. In a low-interest rate environment, a fixed-rate mortgage can lock in a low rate for the long term. In contrast, in a high-interest rate environment, an ARM might be more attractive as rates could potentially fall in the future. Remember, the right mortgage for you depends on your individual circumstances and financial goals. Choosing the right mortgage can feel overwhelming. But don't worry, we've got some tips to help you navigate your options. First and foremost, understanding your financial situation is key. This involves taking a hard look at your income, savings, and expenses. How much can you realistically afford for a monthly mortgage payment? Remember, it's not just the principal and interest. You'll also have to account for taxes, insurance, and possibly homeowners association fees. Next, consider your future plans. If you intend to stay in your home for a long time, a fixed-rate mortgage might be the best option. It offers predictable payments and long-term stability. But if you're planning to move in a few years, an adjustable-rate mortgage could save you money. These mortgages often have lower initial rates, which can be beneficial if you sell before the rate increases. Another factor to consider is the state of the economy. In a low-interest rate environment, fixed-rate mortgages are often a good bet. But when interest rates are high, an adjustable-rate mortgage might be more appealing as rates could go down in the future. Furthermore, consider the loan term. A 30-year mortgage will have lower monthly payments than a 15-year loan, but you'll pay more interest over the life of the loan. A shorter term means higher monthly payments, but you'll build equity faster and pay less interest overall. Lastly, don't underestimate the value of professional advice. A financial advisor or mortgage broker can provide valuable insights into the mortgage process and help you choose the mortgage that best fits your needs. It's also important to shop around. Different lenders offer different rates and terms, so it's worth your time to compare. And remember to factor in all the costs, not just the interest rate. Remember, your mortgage is a long-term commitment. Choose wisely. Your home is likely one of the biggest investments you'll make in your lifetime. Make sure the mortgage you choose will serve you well for years to come. All right, we've covered a lot of ground today. We've taken a deep dive into the world of mortgages, demystifying some complex terms and concepts. We started with an introduction to mortgages, breaking down the basics before moving on to specific types, fixed rate and adjustable rate mortgages. We explored the pros and cons of each, and hopefully, you now have a clearer understanding of these two major mortgage types. The fixed rate mortgage offers stability with its unchanging interest rate, while the adjustable rate mortgage can be a gamble, with the potential for both savings or higher costs as rates fluctuate. It's crucial to compare these two types, taking into account your financial situation, future plans, and risk tolerance. Choosing the right mortgage is a big decision, but armed with today's knowledge, you're now better equipped to navigate this journey. Thanks for joining us on this mortgage adventure. Remember, Money Collate is your go-to place for insightful financial information. Please like, share, and subscribe to our channel. Until next time, make smart choices and watch your wealth grow.